Have you ever had a moment where somebody says something so simple yet so brilliant, your immediate thought is, why didn't I think of that? That was me when I was sitting down with America's IRA expert, Mr. Ed Slott, when he dropped one of the smartest Roth conversion ideas I'd ever heard. And it was this: if you're a high income earner and you expect to inherit a traditional IRA, consider paying the taxes on your parents' Roth conversion. This could very well be one of the most powerful intergenerational wealth strategies you ever use. So, hi, I'm Erin, and on this channel, we talk about how to make smart money moves, especially when it comes to building up a secure retirement, building your legacy, and just building your wealth over time. In today's video, we're going to walk through how one thoughtful move, footing the bill on your parents' Roth conversion, could potentially save your family tens, if not hundreds of thousands of dollars in taxes over the course of a lifetime and really set you up for a more efficient inheritance. Here's the first key point. The IRS does not care who pays the taxes. All they care is that the taxes get paid. So this means that a son or daughter could absolutely foot the bill on their parents' Roth conversion. So if you find yourself in your peak earning years and expect to only have a strong income going forward, doing this could be one of the smartest gifts you give your future self. Because let's be honest, inheriting a traditional IRA, well, that can come with some pretty hefty tax consequences. But inheriting a Roth IRA, well, that's completely tax-free. We're in the middle of the great wealth transfer. An estimated $84 trillion is expected to change hands over the next coming decades. And at the same time, many adult children are moving into their prime earning years, their 40s, their 50s, their 60s, just as their parents are entering into retirement or leaving behind a legacy. And if you know what type of accounts you're setting up to inherit, now is the time to think proactively. And if you're in the position to help, now is the time to ask yourself, would I rather pay taxes now at my parents' rate and inherit a Roth, or would I rather inherit a traditional account and then watch large chunks of it be eaten away by taxes? Let's walk through a real-world example. Imagine your mom was a great saver. She's retired now and has an $800,000 traditional IRA. Because her income is modest in retirement, she's in the 12% federal tax bracket. Now, let's look at you. You're in your peak earning years, bringing in a household income of $350,000. That very well could put you in the 32% marginal tax bracket if you're married and filing jointly, and with raises and bonuses or RSUs, you might even hit the 35% bracket in the future. So let me ask you, what sounds better? Paying 12% on a Roth conversion now, or waiting to inherit this money and then paying taxes at a rate of 32 or 35%? Let's get specific. Let's say your mom never does a Roth conversion. She passes away, you're 60 years old, and you inherit the full $800,000 traditional IRA. We'll assume she was already taking required minimum distributions, and because of that, you'll have to start withdrawing right away too. And it's based on the single life expectancy table. So your first RMD would be just under $30,000 in year one. And that's just the beginning, because each year that life expectancy factor shrinks, which means your required minimum distribution grows. And if this account stays invested, even modestly, we're looking at an account balance that could easily increase, not decrease. Now here's where things get painful. By year 10, the IRS says the entire traditional IRA has to be emptied. There's no flexibility on that. You have to take this money out and it is taxable as ordinary income to you. So let's say you only took the minimum RMDs along the way, just enough to stay compliant. Meanwhile, the account has stayed invested and grew modestly over those 10 years. The original $800,000 could easily have grown to $1 million or more. Now imagine what happens in year 10. You're forced to empty whatever remains in this account. You could easily end up having a 7-figure income year with no deductions, no tax shelter, no easy way to spread this out. And at today's tax rates, you could easily be looking at a tax bill of $300,000 or $400,000 in that year alone. So not only would this push you into into the highest tax brackets. It could disqualify you from important credits or deductions. It could trigger net investment income tax, Medicare IRMA surcharges, and other stealth taxes. All because this account stayed traditional and all because you had no choice but to drain it. That's a tax torpedo, and this shows why planning ahead, especially with Roth conversions, can be a total game changer. Now let's contrast this with the alternative. Now let's say over the next few years you offer to cover the tax bill on a series of Roth conversions for your mom. Let's say she converts $100,000 a year, gradually shifting from a traditional IRA to a Roth IRA. Because she's in the 12% marginal tax bracket, the taxes on this conversion could be relatively modest comparative to our other situation, maybe around $10,000 a year or so, depending on her other income sources and deductions available. And by spreading out this conversion over multiple years, you get to keep your mom in a lower tax bracket. So hopefully you get to pay for this conversion at a 12% rate rather than waiting to inherit it at a 35 or a 37% rate. You're getting the money into a Roth while the taxes are lower, and you'll eventually inherit a completely tax-free account. And once you inherit it, you'll still have 10 full years to let it grow tax-free without worrying about RMDs or tax surprises. That is a massive shift on how to put this money to work for you. So instead of inheriting a 7-figure account that could come with a 6-figure tax bill, you're now inheriting a clean and flexible tax-free asset. That's not just smart tax planning, that is next-level intergenerational wealth transfer strategies. There are other benefits as well. You reduce or eliminate RMDs for your parents. You simplify the estate planning process. You gain the flexibility to time withdrawals after inheritance. And yes, as we mentioned, you avoid being forced to pull large taxable distributions in your peak income years. It's not just about tax savings, but it's also about control and flexibility and being able to pass on wealth in the smartest way possible. So how do you make this happen in real life? Coordinate with your parents' financial advisor or tax pro. Create a schedule for partial Roth conversions over multiple years. Gift the money to your parents to cover the tax bill. Remember, you can gift up to $19,000 per person in 2025 without triggering gift tax or more if you're married. And finally, document everything clearly. You want to keep this clean and you want a paper trail. And importantly, just make sure that everybody is on board and understands the strategy because it's about family and legacy and long-term planning. When Ed Slott mentioned this idea, it immediately caught my attention. It's so simple, yet it's so smart. So I had to do a deeper dive on it. So often when we talk about a Roth conversion, we talk about it from the perspective of a solo strategy. But when you zoom out, that's when things can really get strategic. That's when you have true legacy planning. So let me know in the comments down below. Have you ever thought about footing the bill for your parents' Roth conversion? Or if you're a parent with adult children, would you be open to your children doing this for you? Let me know in the comments. I post new videos every single week. If you got anything at all out of this, please give it a like. If you're new here, please consider subscribing. Or if you know of someone who might get something out of this type of content, please consider sharing. I'll see you soon. Bye. And importantly, make sure everybody is on, did I say important wrong? I've been recently informed that important. I'm so Midwestern that I'm like, important, and people are like, that's not how you say it. I'm trying to get better. Important feels like a lot of emphasis. Let's say over the next few years, you I just make up my own words, because this is really about families. Board and understands the strategy, because this is about what the frick? Family and legacy or fantasy, whatever you want to call it.